worry about is we don't have the imbalances as we did coming out of the pandemic. We don't have supply chain challenges. We don't have as massive of a shortage of labor. We don't have vacancies. There were, two vacancies per unemployed person. So we don't have those major imbalances. Can inflation stay stickier? Can it stay above 2%? Yeah, I think so. But we're not talking about a surge to 4.
So you're not a gold bug?
I'm not. Look, obviously, gold has done quite well. Gold has done quite well, which makes sense as real interest rates fall. But at the same time, look at equities. Look at equities. Look at financials. And this has been one of our favorite sectors, to play this pickup in cyclical activity. Look at technology. Look at, by the way, at some of the AI names. I know I've talked to you about picking up the AI semiconductor companies, but actually one of the interesting trades for next year may be the rest of the Mag 7, which I recently not liked because they're the ones that are spending on AI CapEx. But if you look at the AI CapEx numbers for some of the hyperscalers, they grew about 40 or 50% this year. They're likely to grow about 11% next year. So I think the CapEx spending may be tapering off, but the monetization can actually be picking up. So that's where I look for opportunities.
Given what we know about the former president, do you think he's a threat to the semiconductor AI trade?
Yes. Yes, I think that is a risk to monitor for sure. There's obviously.
Why is that not being priced in while everyone is, really going in on the Trump trade right now? Republican baskets outperforming.
Yeah, I mean, look, you focus on the secular momentum, which I don't think any president is ultimately going to derail. But I do think that if we do move closer to the possibility of a red sweep, you do have to think long and hard about what that means for semiconductors. Look, NVIDIA, companies like NVIDIA, for example, have obviously already pared back some of their sales to foreign stakeholders, but I do think that the headline risk for think about the huge exposure that we have in the semiconductor space from the fact that most of the production is done in Taiwan. Think about some of the other linkages to foreign countries. So I do think it's a headline risk that should be monitored. So I would be aware of that. I would be quick to react to that. But in the meantime, I think you have to focus on the trade that's there, which is AI.
Things could change a lot in a few weeks' time. Anastasia, it's good to see you. Thank you. Anastasia Amoroso of Vine Capital. Equity futures right now on the S&P up by a little more than 1/10%. With an update on stories elsewhere, here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Some of Nomura's biggest clients have halted trading with the Japanese bank as the fallout grows from a market manipulation scandal. Sources say that at least 10 firms, including major life insurers, trust banks, and asset managers, have temporarily suspended some business with Nomura. The bank admitted to manipulating government bond futures by placing large orders without intending to buy or sell them. LVMH's head of wines and spirits is set to leave the luxury company. According to people familiar, the announcement of his exit is expected imminently. LVMH reported a slump in third quarter sales, with wine and spirits once again the worst performing division. The departure is just the latest in an ongoing shakeup of the executive committee at Bernard Arnault's luxury conglomerate. Harvard is struggling to bring in the type of cash it's used to. The university reported that cash gifts fell 15%, now totaling less than $1.2 billion for its last fiscal year. It's the biggest decline in the last 9 years. There had been warnings around rising costs and alumni anger over the school's handling of anti-Semitism. Some of the university's largest donors, like billionaire Ken Griffin, have paused donations over the past year. And that's your brief, John.
Danny, thank you. Appreciate the update. Up next on the program, the risk of a major delay.
We didn't say election night, so we do subscribe to the fact that it will be more of an election week. The market continues to climb this wall of worry. We think the election's one component of that.
That could be one long week. That conversation with PIMCO up next.
is this real momentum from Wall Street?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Equity futures on the S&P up by 0.2% in the bond market, holding on to that 4 handle on a 10-year, up a single basis point to 4.1%. Under surveillance this morning, the risk of a major delay.
We didn't say election night, so we do subscribe to the fact that it will be more of an election week. So once we get past that week, we do think that it'll be a risk-clearing event. We will accept a winner. The market continues to climb this wall of worry. We think the election's one component of that. 2 years ago, it was trying to disprove the recession. A year ago, it was what was the path of the Fed. We think the election's the last rung on that wall of worry.
So here's the latest this morning. The polling averages are tight, with election day fast approaching. The risk of an extended delay is still lingering. Libby Cantrell of PIMCO warning, we should expect to see both recounts and litigation this cycle. And depending on how the election is trending, we could see just as much activity from the Harris camp as we could see from the Trump campaign, which could add delays and uncertainty post-election. Libby joins us now for more. Libby, good morning.
It's a run-on sentence.
Are we talking about...
Good morning.
Are we talking about election day, election days, election weeks?
I mean, election days,
Okay.
absolutely. And that is what we're guiding our clients to, is that we will not, no one's going to be going to bed on the evening of November 5th, understanding who the president is going to be, most likely. Unless it's a landslide, unless we have massive polling error, yet again, obviously possible. But if polling is somewhat accurate, then this is going to likely not, we may not know the day after, we may not know until several days after. If this comes down to Pennsylvania, and I've said, Pennsylvania is the most important state here. Pennsylvania has just been historically very slow to count, particularly these mail-in ballots. That's sort of the dynamic here, is that with the advent of an increase in mail-in voting, many of these states just don't have the infrastructure to process those ballots quickly. So there's nothing nefarious going on. This is what I keep telling people. There's nothing necessarily sartorial going on. But what it is that these states just take a long time to count. Pennsylvania, for instance, took 4 days to count in 2020. So if this election resides on Pennsylvania, and it may not, but it could, then we may not know who the president of the United States is, again, not until maybe Friday or Saturday of election week.
It takes a long time to count. How much litigation could slow things down?
So, just as, and I've had to kind of refresh myself as well a little on kind of, recent history here. I mean, back in 2020, there were 200 cases, both federal and state. So we should expect even more litigation. Both camps, and this is why I do emphasize Harris too, because I think Democrats, they may have a different style around it. Their rhetoric might be a little bit different, but in terms of sort of the tactics, it might be quite similar in terms of filing cases and what have you. So I think we could see an extended sort of protracted litigation here. But again, if it only resides on one state, that will matter. If it's not that close, then it will likely be noise in the background, a little bit like it was in 2000.
If it's not Pennsylvania, what other state do you think it could come down to?
Well, it keeps shifting, honestly. The sort of blue wall, if you will, that is Harris's clearest path to 270. That's, of course, what we're talking about, just getting to that 270 electoral college votes. So in that vein, Michigan is very important, and Michigan looks more vulnerable for her than it did, 3 weeks ago. Georgia and North Carolina also really important. I mean, she could kind of make up, by winning North Carolina, she could lose, say, Michigan or Wisconsin. But again, that's why you kind of come back to Pennsylvania. It truly is It truly is the Keystone State in this election.
If it comes back down to Georgia, what is going on with the voting there? Because this Trump-backed administration said every single vote had to be counted by hand, which is basically 5 million votes. And then a judge said that's unconstitutional. So where does it stand?
Yeah, so it looks like that may be appealed, although at this point that ruling stands. So there won't be, at this point, the hand counting of ballots. We could see that change, however, and this is, again, just more uncertainty around how these poll workers who actually have to administer the election in terms of how kind of their, what the systems are. Georgia is obviously, I think they've done probably some of, the most in terms of reforms in response to what happened in 2020. So they're very well prepared for this. But still, I think it just sort of casts, uncertainty in terms of these processes.
It seems like there's been a lot of uncertainty for a long time. We were ordered by you to go on vacation for the whole summer and then to come back and reassess. And here we are in the same kind of muddle. So I do wonder, I'm looking at this and I'm wondering why suddenly we are seeing some certainty in markets. It seems like there is certainty that Trump is going to win. Yeah. And that is actually trickling into a number of different asset classes. Is there a reality backing that?
Yeah, so I do think, prediction markets, which is where you see a lot of that certainty being expressed, and then as well, crypto and traditional energy, some of these sectors that are likely to do better under a Trump administration. I think that the prediction markets be kind of getting ahead of themselves a little bit. I think that a lot of what their input is polling. And the polling is tightening. There is a bit of a shift here. Now, whether this is a sustainable shift in Trump's, direction, I think remains an open question. We still tell our clients this is a 50-50 race. And this is going to come down. So whether polls have tightened by, a point or, 50 basis points, this is all, for all intents and purposes, with polling error the way it is, this is a complete dead heat. I've said, a knife fight in a phone booth. Kind of a violent metaphor, but quite true in that this is just so razor thin, and it'll come down to both turnout, but also those persuadable voters, and that's what you're sort of seeing, this final pitch, if you will, particularly on the Harris camp, trying to kind of convince those Nikki Haley voters, those folks who are on the edge, to come to her side.
I love that, a knife fight in a phone booth, because it's sort of what everyone feels like who's old enough to remember a phone booth. I just wondering, going forward, when it comes to turnout, what are you looking for to understand who has the upper hand there?
Yeah, so sometimes turnout can be predicated on sort of ground game and infrastructure. Harris probably has an edge there if you just look at the money and her field offices. But again, if you're just looking at kind of some polling in terms of demographics, Trump is doing well with part of that Democratic coalition. The black men, there's a reason why the demographic has been getting so much focus, because Harris needs that cohort to win. Now, she will still win that, for sure, but if she wins them by less, and he loses them by less, then he may win. So this is why you're sort of trying to see, and she's really, I think, the final days and final weeks, gonna really, lean into that cohort, Philadelphia in particular, trying to get that turnout. To your question,
Libby, former President Obama made the case that it was misogyny, but actually, the Democratic Party has been purging these votes from black men 18 to 45 since he ran, every single 4 years. What is the Democratic Party's problem with this group of individuals?
Well, look, I think that just maybe zooming out, the coalitions around parties are changing. And that has been something that has happened, for both parties. If you look at the complexion of the Republican Party, it looks very different from 30 years ago. And if you look at the complexion of the Democratic Party, which used to be, sort of non-college educated union workers, that's still part of the party, but it is morphed, and now they are depending on, college-educated white women, for instance, more than they have before. So I do think it's sort of a broader, kind of paradigm shift, if you will. And to sort of the black man cohort, I think that they are, again, they're trying to make their final pitch about, why Harris is better for that cohort. Well, it sort of remains to be seen. I think people, where our clients are asking us, if you look at sort of just the economic data here, propeller heads here, real wages are up over the last 18 months, labor force participation, market is strong. So sort of for all intents and purposes, you would look at that on paper and think this is great for an incumbent president, for an incumbent party. However, it is that inflation. I mean, inflation, and even though real wages are up over the last 18 months, real wages are still negative since Biden's inauguration. I think that just seems to be hitting voters in a way, that gas and groceries that we have talked about, that will be the reason, if Harris loses, that will be the reason why.
Just quickly, are there actually people that haven't decided? I struggle to believe that. Surely they've decided.
Yes. And I would say the vast majority of people have decided. They decided 2 years ago, right? They decided, coming out of the voting booth in 2020. I mean, the reality is that our electorate is incredibly polarized and incredibly calcified, right? This is why you actually, and sorry about my advice about coming back and thinking that you're gonna, after the summer, you'd be able to have some clarity. But that is why we have not had clarity. But to your question, yes, there are kind of two groups of people. There are people who are actually swing voters, who are actually deciding between the two. And there are folks who are deciding between one candidate and the couch, so to speak, staying home, taking care of their kids, making dinner, and not voting. So it's the persuadable voters, but it's also the folks who you just need them to actually turn out.
Libby, it's good to see you.
Good to see you.
Thank you. Libby Cantrell of PIMCO from New York. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
equity futures on the S&P 500 up 0.2%, adding a little bit of weight to the rally over the last 6 weeks. We are looking at 6 weeks of gains on the S&P 500 for the first time this year. And the bullishness, take a listen to this from Scott Rubner over at Goldman. US stocks can finish the year well north of 6K. That commentary coming earlier this week. And from Bank of America, we caught it with Ocean Kwan earlier this week. As long as inflation remains in check, good news is good news, and that's the way it's been over the last 24 hours. Retail sales and jobless claims, better news.
Yeah, and basically not only retail sales and jobless claims, but you also see the actual earnings that are coming in stronger than expected. Time and time again, the message is clear. Consumers are not losing their spending power. And basically, as American Express's CEO just told us, what landing? We're not seeing a landing. We're still flying, and that's certainly what you're seeing reflected in a lot of, particularly the finance results.
So as that data comes in better than expected, at the front end of the curve, we're still waiting for interest rate cuts from the Federal Reserve. So even with that better data, the lift on the front end is just contained just a little bit. The flexibility is at the longer end of the curve, and that's what we've seen play out. 10-year yields just climb over the last 4 weeks, and again over the last 24 hours. Your 10-year up a single basis point this morning, 4.1%. So the curve is steepening, but this time it's steepening from the long end. That's a bear steepener. And people are looking for more of the same maybe if we get more economic data that comes in, surprising to the upside.
There's a little bit of a creeping fear of reinflation, although not necessarily runaway pandemic.
Wow, that's quite the outfit you've got on.
Yeah, as we can see, we can chat in real time to ChatGPT. And not only that, we can interact with it with video as well.
And I swear, like, if you look at Barrett's GPT history, it's all equations like this.
Now that you know you can do linear equations, can you show us something more complex?
I think so. Okay, next let's try something coding related. So let me take out a computer for this. Okay, so I'm gonna open the ChatGPT desktop app like Mira was talking about before. Okay, and to give a bit of background on what's going on, so here we have a computer, and on the screen we have some code, and then the ChatGPT voice app is on the right. So ChatGPT will be able to hear me, but it can't see anything on the screen. So I'm gonna highlight the code, Command C it, and then that will send it to ChatGPT, and then I'm gonna talk about the code to ChatGPT. Hey, ChatGPT.
Hey there, how's it going?
Yeah, it's going really well. I was wondering if you could help me with a coding problem today.
Of course, I'd love to help you out. What's the coding problem you're dealing with?
Okay, I'm gonna share with you some code. 1 second.
Sure thing, take your time.
Okay.
This code fetches daily weather data for a specific location and time period, smooths the temperature data using a rolling average, annotates a significant weather event on the resulting plot, and then displays the plot with the average, minimum, and maximum temperatures over the year.
Awesome, thanks so much. And in the code, there's this function foo. Can you describe to me what the plot would look like if I had versus didn't have this function?
Sure. The function foo xy takes in a data frame x containing temperature data and a window size y for calculating the rolling mean. It smooths the average temperature, minimum temperature, and maximum temperature columns by applying a rolling mean over the specified window. With the foo function, the plot would show smoother temperature lines because the rolling mean reduces the noise or fluctuations in the data.
Awesome.
This makes...
Thanks so much. So yeah, I definitely will want to apply this function. And so I'm gonna generate the plot and then show it to you. Give me 1 second.
Absolutely. Take your time. I'm excited to see the plot when you're ready.
Yeah, so far ChatGPT has only been able to see the code, and now I'm gonna run it, and then I'll use the vision capabilities of the ChatGPT desktop app so it can actually see everything going on the screen as well. Okay, ChatGPT, I'm sharing with you the plot now. I'm wondering if you can give me a really brief one-sentence overview of what you see.
The plot displays smoothed average, minimum, and maximum temperatures throughout 2018, with a notable annotation marking a big rainfall event in late September.
Fantastic. I have another question for you. Which months do you see the hottest temperatures, and roughly what temperatures do those correspond to?
The hottest temperatures occur around July and August. The maximum temperature during these months is roughly between 25 degrees and 30 degrees, 77 degrees Fahrenheit to 86 degrees Fahrenheit.
What's going on with the y-axis? Is this in Celsius or Fahrenheit?
The y-axis is in Celsius. The temperatures are labeled accordingly, such as average temperature, minimum temperature, and maximum temperature.
Yeah. So as we can see, not only can ChatGPT help me solve very easy linear algebra equations that I need help with, it can also interact with code bases and see the outputs of plots and everything like this going on a computer.
Tech onto the iPhone.
Watch this space. Apple up in a pre-market by 1.9%. The US is pushing for a ceasefire in Gaza after Israel confirmed it killed Hamas leader Yahya Sinwar. President Biden saying, quote, "Now is the time to move on. It's time for this war to end." Secretary of State Antony Blinken making his 11th trip to the region in the coming days.
11th trip to the region, every single one before this. He's basically come back empty-handed. And we were speaking to Norman Rule earlier, who said the timing of this is interesting because maybe this will dictate when Israel will not respond to Iran. Potentially, if you are the White House and you believe what President Biden is saying is that this is a chance to, quote, move on, you would send Blinken there as just a way to potentially withhold Israel from retaliating on Iran right away, because they wouldn't do such an attack, the Secretary of State in the region.
There are a lot of moving pieces here. There was initially a hope that maybe if Bibi Netanyahu could have some sort of symbolic win, that he killed the leader, that he could create a ceasefire. At the same time, who is he going to negotiate with? And at a certain point, what is the ultimate goal? And I think that's what Norm Rule was getting at. And to your question of, is this sort of what the U.S. got into in the Middle East and Iraq, et cetera? How much is there a lack of an end goal that has been articulated that can be worked on that can actually lead to something that's lasting?
We talk a lot about who has the influence here, the United States. I think we need to talk about personnel. How much influence does Secretary Blinken actually have in this situation? And you alluded to it, 11 trips and hardly anything to show for it.
I'm not sure Secretary Blinken holds all the cards here, because this is an administration where all the deal-making, all the decisions come out of the West Wing. If you ask sources stateside or around the world who they call when there's a problem, it's Jake Sullivan and his team. It's Brett McGurk. It's Amos Hochstein. Secretary Blinken is not the first call when there's an issue.
It's an important distinction, a really important distinction. Let's talk about foreign exchange. The US dollar heading towards a third week of gains after getting a boost from stronger than expected US retail sales and an ECB rate cut. Kit Juice of SocGen writing, the market has been fed a steady diet of stronger than expected US data of late. More of the same will keep it bid, but perhaps mostly against the China-sensitive currencies where concerns about US tariffs and disappointment at fiscal easing aren't going away. Kit joins us now for more. Kit, welcome to the program. We caught up with Jeff Yu, someone you know well, a little bit earlier this morning. He's looking for parity next year. Can you get on board with that?
I had this sense that we would get somewhere closer to 120, not that far, on this bounce on a US slowdown, followed by possibly a move to parity then, because the long-run story is difficult. The challenge right now is that the market has bought so many dollars, and when I mean the market, I don't just mean the foreign exchange market. I mean the capital inflows from everybody sucked in by U.S. yield, by U.S. tech stocks, by U.S. exceptionalism, U.S. outperformance overall over the last couple of years. So, the world's savings have gone to the United States. And I mean, I certainly thought 2 months ago that once you started seeing people forced to hedge those or reduce their risk, that would give the euro a bounce, or it wouldn't be anybody's favorite currency, but it is the world's biggest net investor abroad, so it makes a difference there. And then the problem would come back in 2-3 years down the road. I'm now utterly confused. Jeff's much cleverer than me, but I don't think we're going to get to parity on the way down now. I think we have to clean out some of the positioning at some point and get a more meaningful dollar sell-off before the U.S. economic outperformance can drive us lower. So in my mind, it's still a couple of years away. What we are now is, I think, the market completely wrong-footed by the U.S. economy. I mean, along with the Fed and everybody else.
Sure. So, Kit, let's talk about the difference between the Federal Reserve and the ECB. The ECB has also been surprised the other way. The ECB has been talking about data dependence, meeting by meeting. Do you get the sense the market's just in the driving seat making the decisions now for them?
The market certainly bullies them to some degree, in the sense that, you can kind of say, did the Fed go 50 because the market was talking 50, or did the Fed go 50 because they were really shocked by the data at the beginning of August? It's a bit of both. One hopes it's more the data that are doing it, but they might now think, yeah, if we'd seen the data since then, we wouldn't have acted. The Europe is a bit the same thing, but they've got, the ECB's big difference is it's only focusing on inflation, at least in principle. And to that extent, what it was getting, what it's now had is a surprising slowdown in inflation by its standards. And so it doesn't really have an excuse not to get on with easing. We've had 1 month of that, but you'd have to say we're going to get more rate cuts down the road because I suspect inflation will continue to fall because there isn't any growth and the global backdrop's changed. But they are all, yes, the market is pushing because that's what the market does. And the central banks are finding that when they get data that support what the market does, they can't really resist the temptation of going with it.
As you said very diplomatically, Kit, we haven't really learned that much from ECB news conferences and whether it's being bullied by the market or the data. Either way, they've been sort of flipping and flopping in terms of their overall message. That said, there seems like there was a shift. And yesterday, what I thought was interesting was that not only was Christine Lagarde talking about potential weakness, but she made it political. She said that the potential of tariffs in the United States actually increased the risk of downside surprises to the area's struggling economy. How much do you see the ECB cutting rates aggressively to get ahead of whatever might be coming down the pike?
It's hard to imagine the ECB cutting rates aggressively. It's not in their DNA to do anything other than react to inflation. It's still, the job is to hit the inflation target. But I do think they can pick up the pace from possibly, let's put it this way, from what a lot of economists had expected, while not quite keeping up with the pace that's priced into the front end of the curve, because they are alarmed. It wouldn't take much more softer than they expect inflation data to push them into feeling that, yeah, look, we have no reason not to get a move on.
At the same time, Kit, on the flip side, there seems to be this assumption that if the U.S. puts up its walls and does increase tariffs substantially, that will end up with a stronger dollar and a weaker everyone else, and especially given your opinion about how much of an overweight there is in dollar assets. It seems like you disagree. Do you think that people are underpricing the risk to the U.S. economy in that type of scenario?
I think people are looking at the U.S. economy in all scenarios in a state of saying, we know the U.S. economy's done phenomenally well. We understand part of it was the size of the fiscal easing that we saw during the pandemic and immediately as the pandemic was ending. We don't understand why the tightening that came after that didn't slow the economy more. We don't understand how the economy's reaccelerated in the last 6 weeks. Hell's bells, let's stay with U.S. assets because, all the good stuff comes out of this place. And I think there's that kind of reluctance to turn around and say, well, where else can I put my money? The Japanese were selling U.S. debt, like crazy back in July as they were trying to get out of some of their trades. They're right back in. They're buying with gusto again, and probably U.S. equities and so on. So, there's no. I think the market, investors are as much caught out by this unique economic cycle as economists or central bankers or all the rest of us. And the default is the U.S. is a more resilient economy. It's growing faster. There are more investment opportunities. It's got higher yield. If I'm there, why should I cut back, pair, hedge my currency too much? I know I'm going to end up going back in later anyway.
Kip, ahead of the U.S. election, more people are talking about parity, even though I know you think it's a few years away. But you do say there's one trade that is definitely perceived to be safe pre-election, meaning regardless of either candidate. What is it?
Safe trades, Brias. You might have to tell me now. I'm feeling nervous this morning that nothing's safe. No, I think people see the safe trades as being still to be short the euro against various things, and a lot of people see the political trade to be short the yuan against everything.
Short the yuan because either Harris or Trump is going to be tough on China.
Yeah, I think the piece in markets thinking about election trades at the moment is that you get bigger moves on a Trump event. So Trump he's more outspoken, and he's got clear intentions on things like tariffs. So if you think the odds of them are 50-50 for the sake of argument, you get bigger moves on Trump. You don't get moves the other way on Harris because she's less likely to get a clean sweep apart from anything else. So the market ends up concluding, I'll have my Trump tariff trade now because I'm not going to get hurt for having it. And rightly or wrongly, that is a very popular trade.
Kit, appreciate the update from you, sir. We're all confused. Kit Jukes to Sochen. Appreciate it. Thank you, sir. Things have changed a lot. Think about where we were in the summer. You had jobless claims spike to about 250. You had that July jobs report in early August. Everyone's starting to freak out about a deceleration, a breakdown in economic growth in America, and maybe in the jobs market, much more so. And then you get that address at Jackson Hole from Chairman Powell, and it feels like, let's go, 50 basis points, and maybe a string of 50s after that. And then here we are. How much things have changed. I remember the commentary coming from people like Stephen Jen, super sophisticated, very smart individual that Kit knows well in foreign exchange, the author of The Dollar Smile. He comes out and he says, we've accumulated basically this massive long in US assets, this big surge for yield, and that when you start reducing interest rates at the Federal Reserve, the money's going to go home, look for a home elsewhere, beyond the United States, and you could get some real dollar depreciation. That was only 6 weeks ago. 6 weeks later, economic data's better. The Fed maybe has to tap the brakes a little bit. We're talking about skipping a meeting, never mind going 50 basis points. And all of a sudden, we've got people coming on the program talking up parity on euro-dollar next year.
Because ultimately, take a look at the U.S. data you put into the surprise index and how much we've seen it just absolutely skyrocket to the highest levels going back to April. I want to just quote the CEO of American Express. Nothing has landed. We're still flying, not at 48,000 feet, but we're not landing. The economy is still moving along and our cardholders are still spending. This is the rhetoric we're hearing from so many different people. So you've got to think the Fed's still cutting, but you got to imagine this is very different from what we're seeing elsewhere.
Is Torsten Slock doing consultancy over at Amex?
It sounds
like a Slock note.
I know. Well, maybe they're friends.
Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Warren Buffett has sold more Bank of America shares. The lender recently purchased enough of its own shares to nudge Buffett's stake back to 10%, a regulatory threshold that requires rapid disclosure. According to a recent filing, Buffett's Berkshire Hathaway reaped about $370 million selling stock this week. The sale pushed Berkshire's stake below that regulatory threshold, but Buffett's conglomerate remains Bank of America's largest shareholder with a $32.6 billion stake based on Thursday's closing price. Next week, Vice President Harris will be joined on the stump by Barack and Michelle Obama. A senior campaign official tells Bloomberg that the former president will join Harris in Georgia on Thursday. The former First Lady will appear with the vice president in Michigan. It's the first time Harris has appeared with either of the Obamas during the campaign. First Lady Dr. Joe Biden also embarked on a 5-day, 5-battleground state swing this past week, stumping for Harris for the first time in her presidential campaign. And it was a tough night for both Anne-Marie and Lisa. The Mets dropped Game 4 of the NLCS to the Dodgers by a score of 10-2. They'll need to win the next 3 games or they will face elimination. And the Yankees lost Game 3 of their series in Cleveland after the Guardians stormed back to tie the game in the bottom of the 9th. David Fry hit a walk-off 2-run home run in extra innings to secure Cleveland's first win of the series. The Yankees take their 2-1 series lead into Game 4 later this evening. And that's your brief, John.
Danny, thank you. Appreciate that. As a neutral observer, of course, Mets aren't doing too well, are they?
Well, okay, that's not neutral. We already know your affiliation, first of all. And second of all, if you want to know why I'm tired and grumpy, that's the reason why. So there you go.
They're not doing too well. I went to bed and the Yankees were winning. Back-to-back home runs from Aaron Judge, Giancarlo Stanton, amazing. Then Cleveland
kept going.
Then Cleveland comes out. Cleveland comes out and has the audacity to say that it shouldn't count because they didn't think that Giancarlo foot hit the first base. It counted. Went to bed all happy. Woke up. Depressing.
No, that's good. Pretty bad.
Okay, we're done.
I think that's
all right. Good. All right. More on that next week. Maybe. Up next on the program, looking for a bounce in China.
The renaissance of growth has begun for Apple with iPhone 16. I think China, look, that was the biggest issue. That was a headwind. Now it's a tailwind. They have mojo going into the next, I think, 6 to 9 months.
A conversation up next, live from New York. You're watching Bloomberg Surveillance.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Equities firmer by 0.2% on the S&P 500. Under surveillance this morning, looking for a bounce in China.
The renaissance of growth has begun for Apple with iPhone 16. I think China, look, that was the biggest issue. That was a headwind. Now it's a tailwind. They have mojo going into the next, I think, 6 to 9 months. And that's why, look, a lot of the bears, they've yelled fire in a crowded theater for the last month. But I think they go back into hibernation mode, in our opinion. When you look at iPhone 16, this is globally going to be the start of an AI-driven supercycle.
So here's the latest. Counterpoint research fueling hopes China's consumer is bouncing back, indicating sales of Apple's newest iPhones there are up 20% in their first 3 weeks compared to last year's model. Oliver Chen of TD Cowen remaining cautious on luxury retail, saying we lower our organic sales estimates across the board, given uncertainty around the China turnaround and continued pressure on the consumer. Investors and management teams originally anticipated a second-half recovery. That is yet to materialize. Oliver joins us now for more. Oliver, what happened to that second-half recovery? LVMH is still saying things are bad. The latest research on Apple says things are getting better. Where's the truth lie?
Yeah, Jonathan, in the luxury sector, particularly in apparel and aspirational goods, this has been cautious and it will continue to be. The housing market and consumer confidence, as well as low unemployment, it's really weighing on this Chinese consumer, and that's affecting all other luxury stocks, in particular Kering Group as well. LVMH is one of the biggest and the best and the most solid and has a lot of marketing budget, but this has had issues too. So it's something we've been seeing and watching, and a lot of these issues are more structural in China, so it'll just take time. That being said, LVMH, we still recommend it as outperform rated. We think the balance sheet, as well as these power brands, Louis Vuitton, as well as Dior, are great strategies for the long term. But the near term is going to be bumpy because of the housing market issues and valuation there. That'll take a little while to recover.
Oliver, how much are we seeing a troughing out, though, in the story that Chinese consumers don't really want to buy brands that are not Chinese?
Well, aspirational really matters, and these brand stories and the heritage of luxury really matters as well. Also, luxury is a very concentrated industry with the top brands taking the lion's market share. That being said, our survey work does indicate strength of mainland China brands as well, and the emergence of smaller brands too. But luxury really holds a special place in terms of the hundreds of years heritage of brands like Hermes, Dior, Vuitton, and also the story around craftsmanship. Don't forget, luxury is very emotional, and paying this much extra for a bag or jewelry, it really has to do with the storytelling as well. And America has great stories too in terms of our brands as well.
Oliver, quickly, what does LVMH have that Kering doesn't?
Yeah, LVMH has a very diversified portfolio. So LVMH has Tiffany as well, and Sephora. Beauty's been quite powerful. Kering, the portfolio is more orientated towards soft luxury goods, such as Gucci and Kering, and Gucci and Saint Laurent and others. Bottega Veneta is doing quite well, but Gucci is the big brand that matters at Kering, and this brand's in a turnaround. It's really returning to timelessness and re-elevating the brand, which is a great strategy. But overall, a couple things add risk to Kering. A, the Gucci turnaround. B, these brands are more aspirationally focused, and that's been a tougher customer as well post-stimulus.
Hey, Oliver, it's good to catch up, sir. Next time, come in the studio. Oliver Chen of TD Cowen. Appreciate it. I think the right way to frame that is what Kering has that LVMH doesn't, and that's the problem child that is Gucci, as he explained. Up next on the program, Drew Pettit of Citi, Matt Bryson of Wedbush. We'll catch up with Lindsay Piegza of Stifel and Mike Schumacher of Wells Fargo. The third hour, up next.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
End July, we didn't need a rate cut. Mid-September, we needed a 50 basis rate cut. And now we're talking about caution on rate cuts.
But if this market keeps changing narratives.
People might say they're bearish, but when you look at the positioning and look at their equity exposure, it's still relatively high.
A month ago, we said that investors were nervous bulls. Now they have just become bulls.
It's become a good news is good news, bad news is bad news type of environment.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. You're opening about 90 minutes away. Your scores look like this. On the S&P 500, firmer by 0.2%. On the Nasdaq 100, up by 0.5%. Thank you, Apple. Talked a lot about that name. Just where is this U.S. consumer right now? Retail sales says things are totally fine. Procter & Gamble reporting some softer sales growth, but ultimately saying the core of the business is still okay. And Lisa mentioned Amex. Amex lifting its full-year guidance. Consumers doing better than good.
And we've seen this across the financial space. And to me, I thought it was fascinating that the American Express CEO said that this economy is not landing. Maybe we're not at 48,000 feet, but it is still flying and the consumer is still spending. The fact that they're willing to pay money for a premier credit card, you could say, okay, this is just the higher income consumers, but you actually see this across the different sectors. This is an economy doing just fine.
We beat our own expectations and the street too, raising guidance. We see nothing wrong with the fourth quarter. Keep calm, carry on. But to your point, American Express is really for the upper income cohort. What about those on the lower income? Yes, they're still spending, but are they making more, as we've seen from a lot of earnings reports, judicious, more cautious decisions?
Just as you process that stock move on the screen, stock is down 2.5% at the pre-market. It's up more than 50 for the year so far. It's positive by 52.55% year to date. Put that together with some of the financials, the banks, the financial system in America. I know a lot of people might be worried as I say this. Yeah. It seems to be okay compared to what we've seen so far.
I think we could take this a step further. I actually think one of the most interesting aspects of the financial earnings season is the willingness to lend and the capacity to lend and the room to do so at a time where you already have strength. Essentially, this is not only a consumer that's okay, but any kind of incremental rate cut is going to help that lower cohort more and more directly. And suddenly there is a more willingness to lend even at the regional banks because they have some money freed up. This to me speaks to the question of how much of a reacceleration could we get and the inflationary read-throughs from there.
And even with all of that, people still think the Federal Reserve will cut interest rates on November 7th, regardless of what the economic data looks like between now and then.
There's just this quiet transitory that people aren't going to say, that maybe it really was transitory, that maybe these were pandemic-related shocks, and that we can get disinflation at the same time as a reacceleration in growth because there are these sort of, yes, maybe stickier inflation, but not necessarily the runaway that we saw with the excesses from the pandemic era.
Transitory on steroids, okay? Like extend the timeline. I remember that whole argument. It'll last a few months and then it'll fade.
Okay.
Come on.
No, transitory in a lifespan, what does that mean? A couple years
between friends? By definition, life is transitory. Coming up, Drew Pettit of Citi as Wall Street dials back rate cut bets. It's true. Matt Bryson of Wedbush as TSMC results continue to lift chip stocks. And Lindsay Piegza of Stifel on the strength of the U.S. consumer. There's your lineup. Let's see if we can get through this hour. We begin this hour with stocks steady as investors dial back Fed cut bets on the back of better than expected economic data. Drew Pettit of Citi suggesting valuations are full. The solid expected fundamental backdrop has to be considered against the valuation setup. The bar is high. Index multiples are all at top decile levels. Our implicit growth framework in aggregate leaves little room for missteps. Drew joins us now for more. Drew, welcome to the program. It's good to catch up again. Is this index level analysis, Drew? And if you break it down sector to sector, is the bar higher in other sectors compared to others going into earnings season?
That's the beauty of index math, right? It can look a certain way at the index level, but there's opportunity under the surface. And honestly, I would say the growth side of the market definitely has the higher bar. We kind of see that in reactions after earnings reports. And the value, especially the cyclical side, we think has a little bit of a lower bar, so there is a little bit more margin of error on that side of the ledger.
Drew, is that why you like energy and financials at the moment?
Yeah, like to be honest with you, there's not much growth priced in there. And when you look at the bank's reaction to earnings, it was generally really positive. Even when we think about something within industrials like transports, which we upgraded to market weight, you see better results to beats and raises than you do see I would say, reaction to misses. I think a really good example there is looking at Delta, who did not post a good quarter. It had a very small drawdown and then resumed its uptrend. And then you look at United, who posted a great quarter and had a massive move on the back of it. So I would say, like, you could see that implicit growth setup basically explaining some of these moves after results.
But Drew, how far does this have to run? I mean, we're talking about the growth sector. A lot of good news has been priced in, and they've actually beat again and again with some pretty astronomical beats. And this sort of secular story of AI adoption seems to have no limits when it comes to NVIDIA. How much runway is there in something like financials at a time of constraint on the regulatory side and some real questions about exactly the path of the economy?
So look, you might feel like it's a tactical trade, but how the tactical turns into something a little bit more structural might actually rely on the Fed. Now, this relationship isn't causal, but I find it interesting. We don't always talk about the correlation between S&P 500 and cyclical's earnings growth is actually higher to Fed rate cuts than it is, well, then I'd say rate cuts are to valuations. Where it gets messy is when the Fed starts cutting, kind of like what you guys were talking about just before you introed me, but the economy and earnings growth hangs in there. That's how you get upside to markets. That's how you basically shoot past our target and get more of a bull case for the S&P 500 and the cyclicals.
I'm buying all of this. Makes a lot of sense. Here are other people who get on this. Energy is another story. Energy is sort of this question mark. When we ever ask people about energy, I just hear this sigh. You know, well, it's supposed to work because you sort of, theoretically, if you get an acceleration in the economy, it should trickle into the energy sector. You've got everything going on with AI and the power usage. Why is that story not working as well as so many people thought that it would?
I would say that sigh that you hear is the same sigh that we hear. We've probably had more clients tell us that oil's more likely to be at $50 a barrel before 80. So again, very, very, very low bar there, low implicit growth expectations. But what really changed in 15 and 16 is these companies really focused on spitting out free cash flow, not over investing. So again, energy might feel a little bit more tactical. Yes, very commodity driven. But in the background, you got companies, especially the major oils, that are just spitting off so much free cash flow at lower dollar levels of oil.
So, Drew, as you've pointed out, there's not much space for error here at all going into year end. And yet you also acknowledge there's some big volatility events coming up, including the election in early November. Drew, why do you think we're rallying into that? Are you surprised that we haven't been a little bit softer going into that?
A little bit, to be honest with you. I would say coming off the highs in kind of mid-July, I think gave some investors a comeback into certain sectors that have run. Honestly, semiconductors is probably a really great example, an area we upgraded. Maybe it's your last good chance to get in. And then the other piece is earnings. As much as we like to talk about short-term volatility events and valuation setups and so on, long run, earnings direction is really going to power the direction of the market. So I'd say, like, to the upside, it's been earnings and honestly some opportunities to get into some secular winners on pullbacks.
Drew, there's a lot of uncertainty, as Jonathan mentioned, surrounding the U.S. election. BNP Paribas this morning coming out with a note basically saying they're too expensive to hedge. That's why the hedge is unattractive. Would you agree with that?
To some extent, maybe, but look, maybe if we're not talking about outright hedges, I would say there's actually some longs you can engage in to kind of hedge some of your risks here. Look, if you're worried about tariffs, there's a lot of U.S. manufacturers and reshoring, nearshoring, and so on, some themes you can play there to the long side. If you're worried about valuation and what, I would say debt trajectories might do to what you're willing to pay for the market, there's a lot of stocks, self-help stories, and recoveries at pretty low valuations you can buy. There's still a lot of opportunities under the surface for people here because the rally really, until just the past few months, has been so narrow for 2 years.
And opportunities like the ones you just gave an example of, if you're worried about tariffs or worried about the deficit, you can put on for either candidate?
Yeah, I think there's opportunities. And honestly, on top of that, there's a lot of secular trends and themes in markets that aren't going to really be upended by either candidate. Do you think we're going to sit here next year and talk about AI and tech innovation and productivity not being a thing? yeah, maybe something on the fringe changes the slope of that trajectory, but it doesn't inflect it. So I think there's a lot of really good secular stories people can buy into, regardless of your view on the election.
Drew, I love that we get to speak to you because you actually look at all of the balance sheets and try to understand the C-suite and what they're doing. And one thing that is really still a question mark for me is going forward, how much is this resilience, reacceleration, particularly in cyclical areas, going to lead to a higher inflation level? How much are you seeing pricing power come back to companies after, I don't want to even say dormant, it wasn't dormant, it was just sort of a little bit quieter for a couple of months. Is it really coming back?
Honestly, I'm not sure it went away in the S&P 500, to be honest with you. You know, one of our themes for the whole year was show me the money, basically who could generate free cash flow, and a ton of these companies are still doing it. And part of it was looking for companies with operating leverage. And there's a ton of that in the S&P 500. The beauty of higher margins for some of the higher quality large caps has been they could absorb some of the higher, call it cost inflation, and pass it through. So look, margins have not been dented. We still think there's some room for margin improvement ahead. So really, like, I'm not too freaked out about pricing power of the S&P 500. And inflation, to be honest with you, is not necessarily a bad thing for companies that have positive earnings and positive margins.
We lived through that. Drew, it's good to see you, sir. As always, Drew Pettit there of Citi on the latest. Just how low or high this bar is going into earnings season for the next few months. Equity futures on the S&P 500 positive here by 0.2% as we count you down to the opening bell with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Secretary of State Antony Blinken is headed back to Israel. President Biden said he would send Blinken as part of an effort to end the war with Hamas following the death of its leader, Yahya Sinwar. This will be Blinken's 11th trip to the region since the war broke out last year. Israeli Prime Minister Netanyahu said Sinwar's death doesn't mark the end of the war in Gaza, but it's the beginning of the end. CVS is ousting CEO Karen Lynch and appointing David Joyner as its next chief executive. Joyner previously led CVS Caremark, the company's pharmacy benefit business. The announcement also came after CVS repeatedly missed its earnings target, setting off unrest among shareholders that spilled into public view in recent weeks. The company also said that this year's third quarter results will fall short of Wall Street expectations. And American Express shares trading lower this morning, 3.4%, despite a strong showing in its earnings. Amex full-year guidance again delivered better than expected results. The report showed higher spending consumers are turning to credit cards with rich rewards. The shares, however, are at a record, and they did increase provisions from credit losses, $1.4 billion up from $1.2 the year prior. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the morning calls, plus we'll catch up with Matt Bryson of Wedbush on why he sees no end in sight for AI demand on the back of TSMC results. That's next.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The opening bout 1 hour and 15 minutes away. Equity futures up by 0.2 on the S&P, up by 0.5 on the Nasdaq 100. A little bit of a lift across the board here on the Russell. The small caps up by 1/3 of 1%. On the week, the Russell doing okay. We're up by about 2%, the best week since September. Up 2% on the small caps. If you switch at the board, turn the page and get to the bond market story. I want to talk about a 10-year yield of 4.1%, adding another basis point to that move and staring down the barrel of a 5th week of high yields on a 10-year yield. Yesterday, off the back of retail sales, really strong retail sales. This is what Neil Dutter of Renmark had to say on those retail sales. The broader story here is that core sales are running well above the pace of nominal incomes. It is tough to see this strong pace of consumption persisting into the coming quarters. There are still doubts after yesterday's data.
Yeah, and Neil would be one of the people who would doubt because he thinks that the economy is more fragile than many people are giving credit to, and that the Fed needs to get ahead of the curve a little bit more. Key question here, though, is going forward, are we going to start talking about just how much the Fed can cut and whether this market is overplaying Fed cuts next year if American Express's CEO is correct in saying this economy is not landing, it is still flying, consumers have spending power, and we're seeing that reflected in a lot of results that we keep getting.
Joining us in just a moment, the opinion of Lindsay Piegza of Stifel. We'll catch up with Mike Schumacher of Wells Fargo as well. Let's take the opportunity to get you some morning calls. First up, JP Morgan raising its price target on Netflix to $8.50, expecting more balanced growth in 25 as its ad tier builds scale. Next up, Wedbush reiterating its outperform rating on Apple. Analyst Dan Ives highlighting the company's robust iPhone sales in China. That stock is up by almost 2% in early trading. And finally, Bank of America raising its price target on Nvidia to $190, citing confidence in its competitive lead in AI chips. We're up another 1% on Nvidia. Sticking with the chip makers, TSMC's better than expected results lifting chip stocks higher, including competitors like Nvidia. Matt Bryson of Wedbush saying there is, quote, no end in sight to AI-derived strength, lifting his price target on TSMC and reiterating his outperform rating. Matt joins us now for more. Matt, welcome to the program. I want you to help us understand, and particularly me, who's still confused by it all, the difference between ASML and TSMC. I understand they do slightly different things. One makes the machines, the other makes the chips. But Matt, in your opinion, what explained the difference in very, very different earnings?
Yeah, I really think there's two things. One is that you look at NVIDIA and you look at AI, and there is, again, there is substantial demand for AI into 2025. Now, having said that, there's three chip makers who make advanced production. You've got TSMC, you've got Intel, and you've got Samsung. And I think TSMC is doing extremely well. I think both Intel and Samsung are struggling a bit. The second piece, I think, relates to China. So China has been ordering chip equipment in excess of their needs, in part because of concerns around the potential that they might not be able to get that equipment moving forward because of restrictions on exports. And it looks like that's finally normalizing. So when you look at ASML, they have multiple customers. TSMC is strong. A couple of those other customers, Samsung and Intel, are a bit weaker. But also on the China side of things, it looks like that those China orders that have been coming in ahead of expected restrictions on chip equipment exports, that those are finally slowing, and they've been helping ASML up.
Matt, can we talk about NVIDIA as well after you've explained that? Let's just sit on that company. We know where that demand is coming from. We've got a pretty decent idea of who their biggest customers are. So can we talk about their biggest customers? Do you think the investors in their customers will maintain the level of patience they have with the current investment cycle into next year if they're unable to demonstrate bottom line, top line growth off the back of the investments they're making sometime soon?
No, that's a fair question. So I think what we have right now is it's a question of is this generative AI move, is it 4G or 5G? Right. So with 4G, we saw 4G enable a whole set of new applications, which in turn explain the investment in 4G. Right. Without 4G, you don't have YouTube on your phone. You don't have TikTok. With 5G, you didn't get a whole lot. And so we saw kind of investment peter out. I think with AI, what we're waiting for is what is the application? So we still don't have Blackwell. So what does Blackwell enable? We still don't have ChatGPT 5. What does ChatGPT 5 enable? And I think we're going to have to see what those innovations turn into before answering that question. And if ChatGPT 5, if Blackwell is 5G, then we will see investment peter out. But if it's 4G, and I do indeed think that at some point it is 4G and the next set of applications are built on generative AI, then you will see the revenue turn up and you will see continued investment.
Matt, one thing that's sort of surprising to me, especially as we talk about the applications of AI, is why we've seen such a massive divide in the chip sector between the AI-related themes and industrial and auto-related themes, given the fact that they should intersect, right? I mean, shouldn't AI essentially be connected in some capacity to the technology in everyday items? How do you sort of bridge that gap? How do you understand how isolated these different chip sectors can remain?
I don't think they can remain isolated. So at the end of the day, when I'm thinking about what generative AI does, so certainly you can have enterprises that are benefiting from applications where I'm TSMC, for instance, they will tell you that AI is improving the productivity of their tools. And that doesn't impact autos. To some extent, it doesn't impact industrial. But at the same time, I think eventually what you need to see with generative AI is I have to be able, or I have to have an application on my handset that I can access that makes my life better. Or when you're thinking about autos, if Tesla can get the robo-taxi to work and their ADAS is is AI driven, then yes, it certainly changes how you buy your automobile. It creates a new wave of demand. So I think eventually those pieces need to intersect. But I think right now, it's more about building out the infrastructure. And again, if we get ChatGPT 5 and changes the world, I think that certainly we end up in that situation where you end up with those end devices seeing more demand. But right now, it's about building out the infrastructure.
Matt, we were just speaking with Drew Pettit of Citigroup, and he was talking about how the growth areas, and he included the likes of NVIDIA and some of the bigger tech names, have just been on such a hot trajectory and have been increasing and beating, and they really kind of are running out of steam, right? They're not going to be able to beat by the same kind of levels as they have over the past few years, which is the reason why he sees it as a less attractive area. Do you agree with that assessment? Do you think that the revenue surprises are going to be a lot lower than they have been over the recent years?
I mean, certainly you look at the magnitude of beats that we've gotten from NVIDIA, and there's a lot of large numbers. And at some point, those beats have to reduce. Again, though, I think it comes back to we will see the next wave of applications built on generative AI. It's just a question of timing. And so if those applications come sooner and you really start moving value from whether it's the worker in some sense into the data center, then those beats will keep on coming. If it takes a little bit longer, then yes, we could see a pause before. Again, I still think that eventually the next wave of applications end up built on generative AI. You see efficiencies, and people will pay for those efficiencies shifting from the workforce to the data center. And so I think there's another wave of growth. I think the real question is, if we get to the end of 2025, are we seeing that wave of growth, or do we get a pause into 2026? But certainly, I think everyone's investing in Blackwell. You will get beats through Blackwell, and then we'll have to see where we're at.
Hey, Matt. Appreciate it, sir. It's good to catch up. Matt Bryson there of Wedbush, just breaking down the difficulties of explaining what's happening in the industry at the moment, the difference between, say, an ASML, big China effect there, and what you might see from a TSMC and further down the road from an NVIDIA as well. And you pointed to the pocket of strength and a pocket of weakness right now for some of these chip makers.
It's a really motley kind of picture. I mean, the idea that China was trying to get ahead of some potential restrictions, and maybe that's tapering out, but then also anything that has AI anywhere close to its name is, oh my God, yes. But anything that's related to auto sales, not so much. In industrials, we see that with Intel. So at what point do we start to bridge these gaps? Because ostensibly, it needs to be applications that get used in real life, so there should be some crossover.
After November, there's a real chance that life gets harder for some of these names.
It already is. There's a report this week from the Information about how the Commerce Department is looking at the TSMC and whether or not they're giving some of these chips to Huawei, and they're not supposed to.
Up next on the program, we'll catch up with Lindsay Piegza of Stifel, Mike Schumacher of Wells Fargo. Your equity market up 0.2% from New York. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We are looking for a 6-week winning streak on the S&P 500, the longest weekly winning streak of the year so far. if we can close in positive territory. On the S&P 500, up by 0.2%. On the Nasdaq 100, up by 0.5. As we count you down to the opening bell, let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John, a really tough morning for CVS. Shares down 10% in the pre-market trade. They've been under tremendous pressure from shareholders with poor results. Well, we learned that yesterday they ousted the CEO, Karen Lynch, putting in David Joyner, who currently, before this, headed up Caremark, just emphasizing how tough things are for CVS and why the board made this decision. Their third quarter earnings, they warned, are going to miss estimates, also pulling their guidance for 2024, hence the big slump in shares. On the other side of things, late yesterday, after the market bell, it was a strong showing from Netflix, up 6.33%, adding some 5 million customers over the quarter, beating on essentially every single metric, which is impressive given this company was dealing with Hollywood strikes. The concern among analysts, can it keep going if the boost from password cracking down is already over? Finally, ending it with Amex. The declines you're going to see here do belie what the actual numbers were. So 3% lower in the pre-market trade despite 6% gain and more people signing up to their cards, better revenue, better fee generation, upgrading their forecast. But keep in mind, this stock just yesterday was trading at a record high. It's up massively this year, and they also had higher marketing costs, more write-offs, more loss provisions. So, John, it just might be a case of a high bar for Amex.
Danny, appreciate it after a massive rally, which is what we mentioned a little bit earlier this hour. That stock absolutely flying through 2024. Elsewhere, good news is very much good news for equities. Retail sales report adding to the picture of a strong U.S. economy, fueling bets that the Fed is on its way to a soft landing with a possible pause in easing. Lindsay Piegza of Stifel writing this: any additional indications of underlying strength amid sticky inflation will lessen calls for a 25 basis point cut next month, or even allow the Fed to bypass November altogether. Lindsay joins us now for more. Lindsay, welcome to the program. Do you think this economy is re-accelerating, and do you think we're very close to this Fed skipping a meeting?
Well, I do think that yesterday's numbers showing this ongoing resilience and strength of the consumer reinforces the notion that we are on very solid footing. And when we look at what the retail sales numbers are likely to do to third quarter growth, that would be an acceleration above 3% from what we saw even in the second quarter. So this does, I think, do two things. First, it calls into question the Fed's decision to make that outsized rate cut in September, that 50 basis point reduction, but it also now calls into question the need for additional rate cuts, at least in the near term, as we look out to that November policy decision. I do think any further indications, as I said, with a few data points between now and then, any further indications of ongoing strength, further strength in the labor market, on the consumer, a re-acceleration in inflation, does give the Fed an out to potentially bypass that November meeting.
So, Lindsay, as you know, they're talking about removing restriction, not providing accommodation. And you can tell me if that's a distinction without a difference or not in just a moment. But ultimately, when they say recalibration, it feels like they mean autopilot on the way down to neutral. Is that the wrong way of thinking about this?
Well, I do think there's a very important distinction, and unfortunately, I think the Fed sent the wrong message with a 50 basis point cut. It was an inappropriate message to the market to suggest that they were in a rush to not only get back to neutral, but potentially below to provide support to an ailing economy, as opposed to a softer 25 basis point cut, which would have indicated that the Fed is simply removing policy firming at a slow and tempered pace back towards neutral as the data neutralize. So even if the Fed intended the latter, the message was muddled with that outsized rate reduction of 50 basis points. And now the Fed is caught in a position where they're trying to backpedal and not only recalibrate market expectations, but now determine what the appropriate next step will be after that outsized cut.
That said, Lindsay, a lot of people are looking at the growth and potential reacceleration of the U.S. economy and not seeing it get accompanied with inflation really picking up in a material way. We're not seeing that in break-even rates. We're not seeing that in a whole host of other metrics. So at what point do you actually see inflation reaccelerating in tandem with growth, given the fact that there are some reasons for inflation to keep declining?
Well, we are seeing some underlying metrics reaccelerate, push further away from the Fed's 2% target. The core PCE, for example, ticked higher. The supercore also ticked higher. But you're right, 0.1 of a percentage point is not necessarily an indication of a massive reacceleration of inflation. That being said, we're not at 2% yet. So I think the onus is still on the Fed, not necessarily to avoid a reacceleration, but to foster further improvement in inflation. The Fed's job is not yet done, and a reversion, back to 2%, is not a foregone conclusion. So the Fed, motivated by this fear of impending weakness in the labor market, shifted their focus away from inflation. Now we see that the labor market strength appears to be well-founded, and the focus of the Fed should go back to getting inflation under control. Remember, a soft landing is not just about maintaining positive growth, but reinstating price stability at 2%, and we still have quite a ways to go before we can achieve that goal.
This is so interesting, Lindsay, because essentially you're making the argument that maybe the Fed should take more of a page from the ECB and having more of a single mandate in terms of inflation rather than focus so much on avoiding some sort of weakening in the labor market. I just wonder how often we've seen this, where it's basically experiments on either side of the Atlantic, where one, the ECB, pledges to just focus purely on bringing inflation down, even in the face of economic weakness. And the Federal Reserve, to avoid any further weakness, says inflation's coming down, that's good enough for us, we're cutting rates.
Well, I do think that the Fed decided to move its focus away from inflation prematurely. Remember, when we look at historical cycles, the Fed has been forced to raise the Fed funds rate above, historically significantly above, that peak in inflation. So at 5.6%, 5.5% on the Fed funds rate was really the bare minimum that we should have expected in terms of this rate hike cycle. But given the massive amount of liquidity and stimulus and cash pumped into the market, it was really unreasonable to expect that the bare minimum would be the appropriate amount of policy restriction to reinstate price stability. So I do think that the Fed stopped short of where we needed to be, and now, to add fuel to the fire, they've reverted to this policy pivot prematurely before really seeing that underlying disinflationary trend take hold. And that leaves us in a very uncomfortable position as growth remains solid for now. If we do start to lose momentum looking out to 25, 26, and the Fed continues to tolerate above target inflation, the biggest risk for the U.S. economy longer term then is not a downturn like we're seeing necessarily in our developed counterparts abroad, but a period of stagflation.
So, Lindsay, though, is there a chance, if we continue to grow and we do see inflation continue to come down, even though you do have concerns about maybe a reacceleration, is there a chance we could just grow bigger and not hotter?
Absolutely. And I think that's the utopic scenario that the Fed is looking for, that we continue to see this acceleration in underlying growth, resilience in the consumer, positive spending, and positive acceleration in the labor market at the same time that price pressures begin to wane back to 2%. But again, that's a big gamble, a big bet, when we haven't seen that established downward trend in price pressures. We're still seeing very sticky components, sideways movement in the core for 1 month, then, as I mentioned, a reacceleration more recently. And we're also seeing some of these upside risks to inflation that are still hanging out there. International factors that could disrupt commodity markets and lead to higher prices, energy prices, fertilizer prices, factors that are outside of the Fed's purview, not to mention a very contentious election coming up in November. And regardless of which side of the aisle we find ourselves on, either candidate is proposing expansionary fiscal policy, which will continue to complicate the Fed's ability to get back to that 2% level of inflation.
And possibly contribute to higher yields. Lindsay, we've got to leave it there. Thank you. Lindsay Pieksa there of Stifel. Yields were a little bit higher on bonds moments ago. They've dropped now by about a basis point on a 10-year to 4.08%. We had housing starts and building permits data come in a few minutes ago, coming in just a bit softer than expected. We're down a basis point at the front end as well on a 2-year at 3.96. On the bond market, Mike Schumacher of Wells Fargo joins us now. Mike, we've got a 10-year sitting comfortably at 4%. And welcome, as always, sir, to the programme. Is the path of least resistance down towards 3 or up towards 5?
Problem, John, is you've got this incredible event coming up in a couple weeks, and it's basically binary. So once we get past the election, I think it's reasonable to talk about the long-term path, which we think is probably lower. But if there's a sweep, as your previous guest just talked about, let's say it's Republicans or even Democrats, doesn't matter so much, then we do think the path in the near term will be upward. So it's very, very much contingent on the election outcome.
Mike, why is it so contingent? We have a lot of people come on this program still and say it's just event risk, and once it's cleared, we'll get back to business. Why is next year so election dependent for you?
It matters a lot to us because the spending profile is a huge issue. So think about a sweep, more likely to be Republican than Democrat, but it's really not a very different calculus. Unified government, much less fiscal constraint. I know, hard to believe when you've got a deficit of 6% already of GDP, but take that up to 7 or 8 or something like that. The market's going to price more debt issuance, probably higher yields, probably a steeper curve. And it takes a while to unfold. We think the path is actually slower if Kamala Harris leads a Democratic sweep because, frankly, she's not been in that seat before. So people in the markets will want to see her act as president for a couple months, get a better read on the policy path. So I think the legs in terms of yields going up in that case, John, that could go out 5-6 months.
So, Mike, a lot of people have been making this argument, and I buy it on its face. But as we've said before, this year has been the year when logic goes to die. And so I do wonder whether we're discounting the fact that, look overseas, actually, rates are coming down and yields are going lower in the Euro region, especially in the face of slower.